Hi, it's Eric Nuttall of the Ninepoint Energy Strategies with a weekly update. The purpose of this recording is to give a brief summary of the first 6 months of the year. It's astounding to me that we're almost midway through July. We'll summarize the key events in the oil market, the natural gas market, and then give a very quick synopsis of what we see coming for the remainder of this year. I'd say the key theme so far for energy investors has been volatility, clearly. There's been three main sources of that. First has been President Trump. The policy making by social media, the tariff risk that we've had to deal with on again, off again, on again, trade negotiations, and just the uncertainty that is injected into the outlook for the growth of the global economy, and specifically the impact that will have on oil demand. What we've seen so far this year is demand's been holding up fairly well. Two different sources. One is Saudi Aramco earlier this week said that they believe that demand is going to be up about 1.2 million barrels per day this year. A secondary source that we use is OilX. They use proprietary software and satellite tracking and wide different parameters to try to measure it. They have oil demand up 700,000 barrels per day for the first 6 months of this year. So demand is clearly up. I think it's fair to say that the Trump tariffs have had some impact on the global economy and therefore muting oil demand a little. The second key reason for the volatility we've had is, I would say, a pivot by members of the OPEC voluntary deal to return barrels to the market, and not just return them, but on an expedited manner. I was in Riyadh earlier this year, a few weeks before OPEC members went ahead and started that, and it was very non-consensus that they would do that. And so that caught the market by surprise. It did lead back then, at least several months ago, to some price weakness. Here we sit, about 80% of the deal has been unwound. We do think that September we will see the final 500,000-ish of paper barrels to return to the market, therefore ending officially the voluntary deal from the members of OPEC+. So on paper, it's the return of about 2.2 million barrels per day. But again, this deal, by expediting the return, they're basically formalizing a lot of the cheating that went on by the UAE, by Russia, by Kazakhstan. We do think that it was mainly the Kazakhstanian cheating, and then they're basically very publicly thumbing their nose to key OPEC leadership that led to the end of this deal. And so that's something that the market is having to absorb. We'll touch on that in a few moments' time. The third area of volatility very clearly was the Israeli strike, and then joined by the United States on Iran, directly on air defenses, infrastructure, and then obviously the nuclear facilities. It's a debate now in terms of whether that is actually a positive or a negative for the oil market. There's a debate clearly in terms of the efficacy of the strikes. Have they set back Iran's nuclear ambitions by years, or is it months? If it's in fact a year to two, which is what the Pentagon said, it seems realistic that we will not see the enforcement of sanctions on Iranian exports by the United States. And we know sanctions are in place, that they've turned a willful blind eye, etc. A lot of people were anticipating in the second half of this year strong enforcement of that in removing anywhere from 500 to 800,000 barrels per day from the market. I think that expectation now is completely unrealistic, especially as Trump shows high sensitivity to a rising oil price. As we trade in the $67, $60 WTI right now. So those have been the three key areas of volatility that we've had to deal with in oil. For natural gas, we came into the year and there was a lot of hype around AI and data center demand, etc. That remains. What has changed has been weather. Weather has just simply not cooperated in the summertime so far. The cooling degree days have been much lower than what was anticipated. And so some of the balances for where we'll exit the summer, and admittedly, we're only halfway through July. August is a key month for that. But a lot of the calls for, $6, $8 gas and, storage tight, etc. I think that's fading a little. Natural gas was a consensus amongst energy investors and investors in general, very well owned. And so we've seen those stocks weaken off really in the past couple of weeks. There's also been a rotation from momentum to value and value to momentum and all these different things, which we've seen days where, the commodity's flat and stocks are down 4 or 5%. So we're dealing with that in the short term as well. We'll touch on natural gas in a few moments in terms of why we remain bullish in the outlook. So that's the past. What's more important is where we're heading. What I would say is we remain very bullish on the outlook for oil over the medium and long term. We're a little cautious in the next couple of months. The key reason for that is what OPEC plus has been the biggest variable. The return of those voluntary barrels, we think, we're in the summertime now. Saudi, Middle East uses oil for power burn, for air conditioning. The United States, we're in driving season. Exiting in August, September, you go into refinery downturns. You've got the end of the cooling necessities from the Middle East, and I think you'll see the exports from Saudi and other countries more closely align with where their production ceiling is. We haven't seen that yet. And as a consequence, we see meaningful builds starting around October, persisting through the end of next year, unless U.S. shale, which is the only meaningful source of short cycle supply, reacts. It's debatable in terms of, okay, what is that oil price to impact shale growth? I would say it's $67 WTI. We're not there. One could argue that $60 is adequate. Some would argue closer to 55. So the market's going to figure it out. Bob Brackett, who we really respect from Sanford Bernstein, put out a good piece showing historical regression of rig count to oil. He would suggest that we need around 440 active rigs to keep U.S. production flat. We're sitting at 438 now, so we would expect U.S. production to start falling, on which we actually think we're in a structural plateau to decline, owing to the twilight of U.S. shale. We've talked about that in the past. His work would say, well, at $60 WTI, you've got to fall to about 320 rigs. Every rig is responsible for about 10,200 barrels per day of annual production. So that's a drop of about 1.2 million barrels per day. If that were to come to pass, that is enough to remove a lot of the bearish forecasts that people have from energy aspects to Rapidan to Rystad. Everyone's triangulating around 1.5 to 1.8 million barrels per day of builds next year, which it would be quite bearish for oil. So we think U.S. shale and the price will respond prior to that. The positive is, with the return of those OPEC barrels, we're effectively normalizing OPEC spare capacity to about 2 million barrels per day, roughly by our math. When we look at not what stated production is from key OPEC members, but where they've proven it to be, where we estimate actual wellhead production capacity is. That's not a lot in a 105 million barrel per day market. And earlier this week, OPEC came out and said, well, after we return the voluntary barrels, we're going to discuss pausing the return of any more. That's very reasonable because frankly, there's not that much left to return should they so choose. There are some estimates where I think if you fall into the chicaneries of OPEC math, I've seen estimates as high as 8 million barrels per day of spare capacity. That is simply inaccurate. So with the 2 million barrels per day of spare capacity beginning in September, that's very, very bullish. And that's been a major headwind for the oil price. When will OPEC return the barrels? Well, we're basically there in September. So that's quite bullish. The other reasons why we remain bullish is what we see is the peak in non-OPEC supply in a couple of years' time. Energy Aspects forecast it to be about 2028. A large reason why that is going to come to pass, we think, is the maturity of U.S. shale. We think, for a wide number of reasons, geology, spending, discipline, return of capital, all these type of things, U.S. shale can no longer grow meaningfully. And so that's hugely responsible. We also think that decline rates are a major issue where companies are not investing adequately enough. Saudi Aramco earlier this week came out and said that OPEC fields face a 5.5% decline rate. U.S. shale is 45. And so it's this constant need to spend just to stay flat. And the market, the industry is just not spending enough, let alone, the $14-ish trillion required to meet future demand, which is simply completely unachievable. And so when we look at the long-term outlook for demand growth, demand, we can debate whether it's growing very strongly or just strongly this year. It remains at record highs. OPEC released their world outlook this week as well, saying that demand is going to grow from 105 million to 123 million barrels per day by 2050. So very, very strong demand outlook. We see OPEC having essentially normalized their spare capacity by the fall. We have U.S. shale in chronic plateau to declines. We've got non-OPEC production, which is, we're calling 2/3 of global oil production, peaking in the next couple of years. And so we remain very, very bullish. We're just a little cognizant of if the inventory builds of the magnitude that are expected beginning in October actually come to pass, that's short-term bearish for oil. But we're not talking $40 oil. We've never gone there. We think 55 to 60 and time will tell in terms of that oil price. 55 to 60, companies can do just fine. They can pay very high dividends. They can continue to pay down debt. They can keep production flat. Balance sheets remain in check. And as we move through the beginning and mid of 2026, we've normalized spare capacity. Shale, I think, is now going to find a lower run rate. And we think that the oil price will then start to better reflect realities, because arguably it's still mispriced today. There is no geopolitical risk premium embedded in the oil price. Turning to natural gas, we remain bullish on gas because we see a structural mismatch between supply and demand. I mentioned earlier there was a lot of hype coming into this year on AI and data centers. And while that's true, the biggest source of demand really is LNG, both in Canada and in the United States. Canada, we're actually LNG producers now, effective as of July. We sent, I think now 3 cargo ships. We're ramping to about 2.1 BCF a day of feedstock for feed gas demand. That number is going to grow, I think, to about 6 by the early 2030s. It's very positive for not just natural gas, but the differential, the discount for Canadian gas relative to the United States. In the US, their LNG is growing from about 16 BCF a day today to roughly 28, 29. If you add in more modest conservative assumptions for power demand from AI and data centers, call it 6, you've got at least 20 BCF a day of incremental demand, probably closer to 25 by 2030, the next 5 years. Well, we look at, okay, where can that gas come from? There's only a few areas. Haynesville is the marginal basin now. We think supply costs there are at least $4. We think they can grow by about 5 BCF a day from there. You look at Permian, so even with a flat to falling rig count, you've got increasing gas to oil ratios. We still see associated gas growth of maybe 5 to 6 from there. The Marcellus is pipeline constrained, so let's call it flat. So really you need to activate, there's got to be a call on the more marginal gas basins to match that increase in demand. And so we think it's reasonable to see that the gas price is going to be anywhere from $4 to $5 MCF. That's USD. For Canada, with LNG ramping up, we think the discount's going to fall to about $1, $1.10, somewhere around there. So that's a very, very profitable environment for natural gas producers. And so whether it's in the Canadian oil sands, whether it's in the Montney, whether it's in some US companies where they have 20 years of inventory, our primary focus today remains the same as it has been for the past several years. We think the market is completely underappreciating the compounding impact of meaningful share buybacks over time in an environment where there's too much uncertainty to want to grow production meaningfully. And so we think that there is a call on oil growth, sure as heck a call on natural gas growth. We think that we're in a multi-year bull market for all forms of energy as the world's getting bigger, the world's getting more affluent, living standards correspond very much to an increase in power demand, electricity demand, oil demand, gas demand, coal demand, you name it. We need it all. And so there are massive opportunities in that. We will remain flexible, fluid in allocating our investors' capital in the subsectors where we see the most short-term upside. And we continue to monitor things literally on a daily basis, anything from Kazakhstani oil production to demand in real time, to power burn, to LNG, et cetera. And so that's the value add that we're bringing to the table for our investors. And so in summary, we remain very bullish in the outlook for the energy complex. We're medium and long-term very, very bullish on oil. I think we'll see all-time highs once again in the next several years. The world has not come to grasp with the twilight of US shale, leading to a peak in non-OPEC supply in the next several years. OPEC, where due to other priorities, they have not been meaningfully investing in new capacity, facing a 5.5% decline rate. Their spare capacity will be normalized by the end of this year, and we think demand will continue to grow longer and stronger. Natural gas, it's a very simple thesis. LNG build-out, AI, electrification, the going from a bridge fuel to the fuel of the future to meet a growing power demands. We think $4 is essentially a floor price, more likely 5. And in that context, we can buy gas producers trading at 14 to 17% free cash flow yields, not meaningfully growing their production and instead buying back their shares. So appreciate your time. We wish you and your families a spectacular summer, and we look forward to catching up in the fall.